Yes. So I think we left at the point whereby I told you that I'll ask you this figure, and in fact, we haven't rubbed the board. We haven't rubbed the board. So what were you having to get here? What were you having to get here? What was the figure there? What was the figure there? So that I know whether we are together. What was the figure there? We left where I told you I'll ask you for this figure. 904.4. Is that correct, Anthony? 904.4. Is that correct, Anthony? So 904.4. So it is 904. 904.4. 904.4. And in this case, we had actually concluded on our workings. And of course, he said, when you come into today's class, we're going to look at the final statements, how they'll end up having to look like. We're going to look at the final statements, how they are going to look like. The final statements, how they are going to look like. So the final statements, how they're going to look like. Yeah, so can in this case look at HEMA group. HEMA group. So you have in this case HEMA group. HEMA group. HEMA group. We have HEMA group. Consolidated income statement. Consolidated income statement. Income statement for year ended. For year ended 30th of April 2017. 30th of April 2017. So 30th of April 2017. And of course, in this case, our figures are actually in shillings of millions. And automatically in this case, so we are going to start with revenue. We're going to start with the revenue. So revenue, we're going to start in this case with the revenue. Revenue. So for revenue, in this case, we've been given revenue for HEMA Limited. We've been given for Shuka Limited. And of course, we've been given for Ajabu Limited. We've actually been given for Ajabu Limited. We've actually been given for Ajabu Limited. So, so we are going to add what? We're going to add what? We're going to add, in this case, 1200 plus 600 plus 600. Will we add the 300? Will we add the 300? Will we add the 300? So we're going to add, in this case, 1200 plus 600. Will we add the 300? Will we add the 300? Will we add the 300? Are we going to add the 300? Seems most of you haven't been able to. So I can see Valerie says yes. Valerie says yes. So, so Anne Simuli, are we going to add the 300? Are we going to add the 300? So of course you won't add, because in this case, Ajabu was what? Was an associate, was actually an associate. So you see, in this case, for associate, what you end up having to only consider in the income statement, you take a portion of the profit after tax, a portion of the profit after tax. So we won't end up having to add. We don't actually, in this case, consolidate the associate. So we won't add it. So, but then in this case, we'll less. There was an intercompany sale. It was of how much? There was an intercompany sale of how much? We're going to less an intercompany sale in our workings. There was an intercompany sale over 100. There was actually an intercompany sale of 100. It was 100. It is not 50. I don't know where Irene is getting 50. There was an intercompany sale between the companies of what? Over 100. Over 100. And therefore, in this case, I think you'll get 1700. 1700. 1700. Then we can go to the cost of sales. We can go to the cost of sales. So for the cost of sales, in this case, we'll add 650. 650 plus 250. 650 plus 250. We won't add the 100 because it was for the associates, but there was an intercompany sale here. Intercompany sale of the 100, you less automatically. You will actually less in this case what? Automatically. You less automatically. You less automatically. Then there was in this case what? Unrealized profit. So I think there was a URP. So unrealized profits on closing stock. So there was unrealized profit on closing stock of unrealized profit on closing stock. We have in this case debit cost of sales and credit PPE of 40. Then in this case also we have there's a URP somewhere. There's a URP somewhere. Intergroup sale of fixed assets. There's a URP of in this case 10. I think you can be able to see it. I think it's working 3. There's a unrealized profit of 10. So which means in this case it will likely end up having to increase 10. Then of course in this case depreciation undercharge. Is it depreciation? There was a depreciation, so intergroup sale of fixed assets. So there was a profit. So there was an overstatement of what? Over profit on that sale of an amount of 40. So in this case, we likely remove that profit of 40. So the profit of 40, we likely remove the profit of 40 by having to add. So the profit of 40 by having to add. Then there's in this case what? Depreciation overcharge. There's a depreciation overcharge of 8. I think there's a depreciation overcharge of 8, which will likely end up having to less from the cost of sales. Will less from the cost of sales. So you have the intercompany sale of 100. We have in this case the unrealized profit of 10. Then in this case we have what? The profits. The profit that in this case was realized on the intercompany sale of the fixed assets. We remove it. So you remove it by having to debit in the profits and loss, by having to add it on the cost of sales. Remember what we're having to say, you debit the cost of sales. These ones, there's somewhere we say debit. Then there was this what? Depreciation overcharge, depreciation overcharge of 8. We also in this case do what? Remove it. So what do you get when you do the computation there? There's you get 800 and is it 42 or 58? Valerie, can you confirm the figure? It is 650 plus 250 minus 100 plus 10 plus 40 minus 8. What do you get? 842. Should actually be 842. 842. And therefore, in this case, you should be able to get the gross profits. The gross profit. What is the gross profit when you do the computation? When you do the computation, then in this case, we have investment income. So you have investment income, which is part of the items you can be able to see there in the investment income. We have investment income. Investment income. So this we are getting how much? The gross profit, the GP 858, 858. This investment income, we had done an adjustment. What was the figure? This is a working we had done for investment income, where we eliminated interest and of course dividends. We eliminated the interest and of course what? Dividends from the subsidiaries, from the subsidiary and associate. We were getting a figure of how much for this investment income. Of course, in this case, what you have been given there for HEMA Group is 70, but I told you eliminate the dividends that they were paid by the subsidiary and of course what the associate and plus what the interest. So we got a figure of 8. You should be able to be having that figure in one of your workings, a figure of 8. Then after that, we go to distribution costs. Distribution costs. So for the distribution costs here, we have for the holding company 100 plus 40. Remember, we don't add for associate. We don't consolidate associates. We use the equity method. So don't add. Please don't add. Don't say 100 plus 40 plus 30. No, we'll just be able to consider the part for the associates only in this case in what? In the consolidated income statement. And therefore, in this case, this one, if you add, you get 140. 140. You can be able to see this one doesn't have an adjustment. So you can imagine you having to miss out on this mark in an exam. It doesn't have an adjustment. Just the way it is. You just add and the examiner comfortably gives you the mark. So these ones, maybe I can excuse you because maybe in this case, some of the computations I've ended up having to mix up you. So you might not end up having to get this figure correctly. But for this one, surely. For this one, surely. It is just direct, the way it is. In this case, in the income statement. We have administrative expense. Administrative expense. We have in this case 130 and 90. 130 plus 90. I think it is 210. 210. Then we have finance cost. We have in this case finance cost. Finance cost. We have in this case the finance cost. Finance cost. We have the finance cost. So finance cost. Finance cost in this case we have 40 plus 20. 40 plus 20. But remember there was that interest. There was that interest of 10. 130 plus 90. So you get 220. 220. So I think it is 220, not 210. It is 220. I think it is 220, not 210. So we have finance cost. We'll add 40 plus 20. But remember, there was that interest of 10 that in this case was having to be paid by Shuka to what? To Hema. Shuka to Hema. And of course, in this case, we were saying what? You end up having to eliminate any what? Intercompany balances. Intercompany balances. You eliminate intercompany balances. If you can recall, so that interest, we ended up having to deduct it here. I think it was deducted here. On the investment income, if you look at that working, we've deducted that interest of 10. So you also end up having to deduct it here because it was a finance cost for what? For the subsidiary company. The subsidiary company was having to pay the holding company. So they were owing each other money. Any intercompany balances, you eliminate. So we eliminated here from the investment income for the holding company. We also eliminate it here as an amount having to be paid by what? By the subsidiary. So therefore, in this case, you less 10. So it will likely end up having to come to 50. It will come to 50. It will come to 50. Then we have impairment of goodwill. Impairment of goodwill. Impairment of goodwill. Impairment of goodwill. So we had done this working. So I think it is working 1 there somewhere. So it was coming to a figure of 6.6. A figure of 6.6. 6.6. So we'll be able to get now in this case what? The profit before tax. We can get the PBT. The PBT. The PBT. So you can do the mathematics and get the PBT. Get the PBT. The PBT. Then of course you have the tax expense. Tax expense. So the tax expense also doesn't have any form of adjustment. So in this case, we just take 70 plus 50. It will be 70 plus 50. It will come to a figure of 120. 120 or 130? 120. So what are you getting here? You can give me the figure here. You can give me the figure here. So 858 plus 8 minus 140 minus 220 minus 50 minus 6.6. Minus 6.6. So what do you get? When you do this one, 858 plus 8 minus 140 minus 220 minus 50 minus 6.6. 449.4. You get 449.4. 449.4. Then you can get the part there. So the part, you can get the part. Huh? So the part after that, so it will come to a figure of this is 4. This is 9, this is 2, this is 3. 329.4. I think you'll get 329.4. 329.4. 329.4. 329.4. So this is basically the part. So after this is when in this case you can only be able to consider now in this case the share of the profits the share of the profits of what? Of the associate. So this is basically where, after this particular figure here, is where now the interest in the associate actually comes in. Because remember, we've not actually been able to consolidate the expenses and incomes by adding here. Under the equity method, you only in this case consider a share of the profit after tax of what? Of the associate. So therefore, in this one, after you've been able to get the part, you can now in this case add the profit this particular Hema Limited was having to share, in this case, in what? In the associate. And therefore, in this case, you add on that, can continue. So shillings in millions. So you add on that the profit share. So the associate share, the profit share in associate, the profit share in associate. And of course, this one, you take the profit after tax. If you look at the profit after tax of, in this case of the associate, Ajabu, so profit for the year, income tax. So in this case, you have 70. It is actually 70. And of course, in this case, in the associate, they were having to control how much? 40%. So you'll take 40%, multiply by that, what? 70. Multiply by that, what? 70. Multiply by that, what? 70. But there's something in this case, we said you can end up having to deduct, you can actually end up having to deduct from this, what? This particular, in this case, what? Profit share in the associate. So you'll take 40% of profit share of the parts of the associate, but what do we deduct? In any case, there was actually any form of what? Of impairment. In any case, there was actually any form of impairment during the year. You actually end up having to do what? To deduct. Any form of impairment during the year, you end up having to deduct. And therefore, in this case, if you look at what we computed as the impairment on goodwill in the associate, So you have in this case, the impairment on goodwill in the associate is actually 60% of 30. 60% of 30. It is 60% of 30, so 60% multiplied by 30. Remember, this one was the goodwill in the associate. This one was for the entire period, but now in this case, you only need in this case to consider for the year. So you multiply by 20%. This one is 18. You multiply by 20%, you get 3.6. So we'll less here 3.6 from this one. So 3.6 less 3.6. What do you get? Remember, in this case, the goodwill for the associate was 30. The goodwill since acquisition was, in this case, the impairment since acquisition was 60%. That one for the year, for which you are considering the profits, is actually 20%. So it is 18. This one by this, you get 18. Since they acquired it, it is 18. But now you only take 20%, which is for the current year, which ends up having to be 3.6. So you'll get what? You'll get what when you do the computation? So 40% multiplied by the part of the associate less an impairment on goodwill. You'll get 24. You're saying 24.4. 24.4. 24.4. So 24.4. So 24.4. So hope that figure is correct. 24.4. 24.4. So you can in this case add on that. So 24.4 plus 329.4. 329.4. You'll get in this case the profits after tax. The profit after tax, after being able to consider in this case what? The profits from the associates. The profits from the associates. So what do you get when you add? What do you get when you add? So I can see Valerie says she's lost. So remember, here we haven't been able to consolidate the incomes or expenses of the associate. So when you're using the equity method, this is where the associate comes in. This is how you basically include it as part of the members of the group in terms of what the income statements. You'll go to the income statement of the associate. You take the profit of the associate. And of course, it is there. If you look at the question, it is there. So what in this case is the parts. Look at Ajab. The parts in the question, profit for the year, we have in this case what? The profit for the year, in this case, we have how much? 70. After being able to consider tax, income tax expense of 31, the profit in this case after tax for the associate is 70. when you're using the equity method, and of course you can go back to the notes, which I told you in this case, you need to reread several times so that you get these things to stick in your head. So you take a portion of this, this is how you include the associate in the income statement. You can see here we haven't included its expenses or incomes. You don't consolidate. Only subsidiaries are consolidated. Where the associate basically now in this case is included in the combined income statement, it is this element. It is this element. Only this element is now including the associate in the income statement. You take a portion or a share of the profit after tax of the associate. In any case, we said there was actually an impairment, you end up having to less. And therefore, in this case, you'll be able to get 24.4, which you'll add here. Because in this case, they took a portion of these profits. You'll end up having to add it here. So you get 353. I can see saying 353.8. 353.8. So 353.8. 353.8. 353.8. So this basically now in this case, it is the total profit. It's not part, but the total profits. The total profits. The total profits for the group. 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 So we can in this case get those ones attributable now in this case to what? To the non-controlling interest. The profits attributable to the non-controlling interest. The profits attributable to the non-controlling interest. So attributable to NCI. Attributable to the non-controlling interest. Non-controlling interest, they are controlling 20% because this HEMA group, HEMA Limited had acquired 80% of the subsidiary, which is Shuka. So it means the non-controlling, those who are not controlling, the minority, it is 20%. It is 20%. It is actually 20%. And therefore, in this case, the profits, you take in this case 20%, the profits for in this case, what? The Shuka Limited, you'll end up having to take 20% of these particular profits in Shuka Limited. The profits declared for Shuka Limited, if you look at that income statement, it is actually in this case an amount of 150. So you'll likely in this case take 20% of these 150, 20% of these 150. But in this case, on this particular 150 here, there was a depreciation overcharge of 8. Depreciation overcharge of 8. Then we also in this case must be able to consider the impairment on goodwill. The impairment on goodwill that in this case was attributable to what? To the associate. Remember, when you are doing the computation, there's somewhere we did the computation and we said goodwill, we said goodwill to the non-controlling interest was actually coming to, I think, 5. Was it 5 or something? It was actually in this case 5. It was 5. So, so you have in this case the impairment of goodwill. It is actually in this case how much? 5. So it's actually 5. So 5 is actually 5. Says yes, 75 minus 20% multiplied by 350. So you're having to get in this case what? 5. So this goodwill was actually impaired. 60% of it is actually impaired. So the impairment is actually the impairment is actually in this case 60%. 60% multiplied by 5, but for the current year is actually 20%. Is actually 20%. Is actually 20%. And therefore, in this case, if you do the computation, you'll get the impairment for the goodwill that was supposed to be deducted from these profits for the current year in Shuka Limited. I think it will come to 0.6. It will come to 0.6. It will come to, so let's see 0.6, which is the impairment of goodwill in the current year. Remember, in this case, the goodwill attributable to non-controlling interest, we computed and we got to what? 5. So since acquisition, this goodwill has been impaired by 60%. But for the current year, the impairment is only 20%. 20%, of which, if there is an impairment on goodwill, it is an expense in the business, which now in this case, you have to do what? Consider it in Shuka Limited. We must be able to deduct it on these profits of Shuka Limited because it was an impairment loss. It was an expense in the current year. So the expense in the current year in terms of impairment of goodwill, it is 0.6. It is 0.6. So it will end up having to do what? Affect the profits there. It will likely end up having to affect what? The profits there. So in this case, you can actually take 20% of 150 plus 8. Then in this case, you minus 0.6. So I don't know what you're having to get. You can do the computation. What do you get in this case when you do the computation? You get 31. You get 31. You get 31. Then in this case, you can now get the profits attributable to the parent company. Profits attributable to the parent company. Attributable to the parent company. So these ones will likely go to the 80%. So these ones will go to the 80%, which now in this case, it is the parent company. So for the NCI, they'll enjoy these profits. But now in this case, the parent company, they'll enjoy the difference. So what is the difference? I think you'll get 322.8. 322.8. You'll likely end up having to get 322.8. 322.8. So these are the profits now attributable now to these HEMA Limited, to HEMA Limited. To Shuka Limited, they are these ones. So that's basically, in this case, you'll end up having to do what? Prepare the consolidated income statement. So take note of this particular area here. It is very important. That's basically, in this case, you include, now in this case, what? The associates in the consolidated financial statements. So you can now, in this case, look at the consolidated statement of financial position. The consolidated statement of financial position. So what you need to be able to also take note, some of the computations, they don't need any form of adjustment. So don't go into the exam room with the perception that in this case, this particular area is difficult. There's nothing I'm going to do. No, you must be able to score a mark out of these. Some of the computations, you just pick them the way they are and you add. So long as you know the concept, you just pick them the way they are and you place them in the final statements without any form of what adjustment. So you can't afford in this case to score what? A 0. With this kind of entries, you might realize probably in this case, if the marks were 10, you might score 4 or even 5. The ones that needed adjustments, they're only in this case, how many? Only in this case, 5 items, or maybe 4 items. But for like 5 or 6 items, no need of adjustment. You just, in this case, add them and you get the final figures. So why should you score a 0? So you can't get into the exam with the perception that in this case, you won't be able to tackle this particular area. So very important, you take note of that. So now in this case, you can look at the consolidated statement of financial position. HEMA Group consolidated statement of financial position. So consolidated statement of financial position. So this one is normally as at 30th of April, 2017. 30th of April, 2017. So we can have in this case our shillings in millions, our shillings in millions. And of course, we can start with the non-current assets. Non-current assets. So for the non-current asset, in this case, the same case, you only consolidate those ones of what? For the subsidiary. Don't add those ones for the associate. Don't add those ones for the associate. The only figure that will end up having to appear here to include the associate in the group, majorly as a result of not having to add those assets, is what we call what? Investment in associate. Investment in associate. And therefore, in this case, if you look at the statements of financial position, we have in this case property, plant, and equipment. So you have in this case 1250 plus 800. Don't add the 650. You don't consolidate. But now in this case, there was an intergroup sale of what? Of fixed assets, which in this case led to a profit of 40. And in this case, if you look at the entries, we said in this case, you credit property, plant, and equipment. So there's that 40. If you look at the working for intergroup sale of fixed assets, the complete entry, in this case, you debit the cost of sales, then you credit what? Property, plant, and equipment. So we'll end up having to less 40 here, which is the profits on the intergroup sale of what? Of the fixed assets. You eliminate it there. You eliminate it there. Then in this case, you also, in this case, there was a depreciation overcharge. There was a depreciation overcharge. So they charged in excess depreciation by what? By 8. So it means you'll add it back. To correct it, you'll add it back on these assets. you'll add it back on these assets. And therefore, you should be able to give you the value of what property, plant, and equipment. Then you have the asset of intangible assets. Intangible assets. Intangible assets, you just pick them the way they are. No form of adjustments. 200 plus 70. 200 plus 70, you'll be able to get 270. What do you get when you do this computation? So 1250 plus 800, I think you get 2050 minus 40, 2010 plus 8, 2018. Get 2018 years. You get 2018. You get 2018. 2018. You get 2018. Then we have investments. So we have in this case what? Investments. So investments, we have investments. We have investments. We have investments. So investments, you've actually been given a figure of 850. A figure of 850. So you take 850 plus 50. 850 plus 50. But now in this case, you likely end up having to less from these investments. The amounts they ended up having to pay as what? As the purchase considerations. As the purchase considerations. Just to be able to explain. So if you look at note number one, the number of investments they did. So for example, in this case, they invested 100 million in the 10% loan stock. They invested 100 million in the 10% loan stock, 10% loan stock. So in this case, you likely debit the 10% loan stock, and of course you credit the investments. This is how you'll be able to complete this particular entry. So it means in our loan stock, in the statement of financial position down there, when we'll be doing the non-current assets, non-current liabilities, we'll end up having to less this 100 million from the 10% loan stock. So this is the complete entry. So ideally, it means here, in the investments, we likely end up having to less that 100 million. We less that 100 million. So the same case, you are told that in this case, to purchase, there was a purchase consideration, still under note number one. So you have in this case what? Purchase considerations. Purchase considerations. We have in this case purchase considerations. So in this case, in the Shuka Limited, which is the subsidiary, they ended up having to do what? Pay 300 million. And of course, in this case, in Ajabu, they paid 200 million. So in Shuka, in this case, you have an amount of 300 million. 300 million. So what will happen with this one? It is that we'll debit the purchase consideration, and we'll credit investments. We'll credit the investments that we have there. Then for Ajabu, in this case, we have an amount of what? They paid 200 million. So we'll debit the purchase consideration. Then in this case, credit the investments. We'll likely end up having to credit the investments here. So these particular amounts here, we less from these investments. We less here, in this case, 300, and of course, less here, 200. And therefore, it will be able to give us the figure for the investments. It will be able to give us the figure for investments. So you'll get a figure of how much? You'll get a figure of how much? So in this case, 850 plus 50, that is 900 minus 100, 800, 500, 300. I think you'll be able to remain with 300. You'll remain here with 300. You'll remain here with 300. Then we have, in this case, goodwill. We have goodwill. So goodwill, if you look at the question here, you've actually been given a goodwill of how much? So we have intangible assets, then investment. So goodwill, we actually computed for the two companies. We in under working one or working two, 25 plus 30. But there was an accumulated impairment of 33. This working we did. So just look at the workings. This one was for the subsidiary. This one was for the associate, but there was an impairment. So you less the 33. That is 55 minus 33. You get a figure of 22. Then we also, in this case, computed investment in associate. investment in associate. We computed investment in associate. Investment in associate. So we were getting how much for investment in associate in our workings? So that's the reason as to why in this case we don't actually consolidate the associate is because we have this figure. We only get this figure to now include it here. You can see under the assets, we are only adding those ones for the holding company and those ones for the subsidiary. So you basically, in this case, consolidate the associate in the statement of financial position by this particular key figure here, which you get what? Just an investment in what? In the associate. So we got a figure of 212. We got a figure of 212. So that is the investment in what? In associate. So I think those are the only ones. Then in this case, we can be able to go to current assets. Current assets. We can go to current assets. So for the current assets, we have in this case inventory. Inventory. So still you take those ones for the holding company and subsidiary. Don't take those ones for, in this case, what? The associate. So for inventory, you have 200 plus 75. But there's something you are supposed to do with this inventory. What will we do with it? This inventory, what are we going to do with it? Try to think. Ruth, try to think. This inventory, what are we going to do with it? I can see Valerie says you less 10. So I think there was a URP. There was a URP of how much? 10. So we less 10. We less 10. We less 10. And of course, if you less, you'll get 275 minus 10, you get 265. You get 265. 265. Then we have, in this case, trade and other receivables. Trade and other receivables. So for the trade and other receivables, we have, in this case, a figure of 300 plus 90. 300 plus 90. 300 plus 90. But now in this case, we need to be able to check whether there were any intercompany balances in terms of trade receivables and trade payables. So if you had an intercompany balance, we end up having to less. And of course, if we look at our workings, I think there was an intergroup balance of how much? 50. There was an intergroup barriers of 50. So at least those ones, I'm happy you are able to identify them very fast. So those ones are easy adjustments that in this case, you can be able to just identify them very fast, and therefore you shouldn't score a 0. So that was actually 50. You can remember this one. There was an intercompany balance in terms of trade receivables and trade payables. So you less it here. And of course, also you'll be able to consider it in the trade payables. Then in this case, you have cash and cash equivalents. Cash and cash equivalents. Cash and cash equivalents. Cash and cash equivalents. So in this case, we have 150 plus 40. So you get, in this case, 190. 190. And therefore, I think those are the figures. Those are the figures. We can go to the other side of equity and liabilities. Equity and liabilities. Equity and the liabilities. Equity and the liabilities. Equity and liabilities. Equity and liabilities. So for equity and liabilities, you'll first of all, in this case, consider the ordinary share capital of the holding company and share premium. So ordinary share capital. In this case, it was 1,000,000. We have, in this case, the share premium, which has no any form of adjustment at all. Share premium. In this case, we have 300. Then we have, in this case, the revaluation reserve. Revaluation reserve. Revaluation reserve. Revaluation reserve. Revaluation reserve. The revaluation reserve. Revaluation reserve. So for the revaluation reserve here, we have for the holding company, which is actually 200. We have, in this case, for the holding company, which is actually 200. 200. But now, the revaluation reserves for the the revolutionary reserves for the Shuka, and of course in this case what Ajabu, is actually 50, and of course what 50 and of course what 50 and of course what 50. So remember in this case, when you're having to in this case calculate the goodwill, so we calculate the goodwill in this case, we consider the revolutionary reserves at the point of what of acquisition, at the point of what of acquisition. But now in this case, there were those reserves that were in the Shuka Limited and Ajab Limited by the end of this particular what year. So you'll take 80%, you'll likely take 80% of the post-acquisition, so 80% of the post-acquisition revaluation reserves. Of the post-acquisition revaluation reserves. In this case, remember what we do with the revaluation reserves and the retained earnings. When you are computing the goodwill for these two, we've already considered the pre. We've already considered what the pre. We've actually already considered the pre. Or in this case, what the subsidiary and of course what the associate. But for the posts, we haven't accounted for it. So it means in this case here, we likely end up having to take the revaluation reserves of the holding company, which is 200. Then we take a portion of the post-acquisition revaluation reserves. And therefore, in this case, at this particular point in time, we're having to be told the revaluation reserves in this case for Shuka is actually what 50. But they acquired it when it had a revaluation reserve of how much? 20. I think it is 20. 20. If you look at note number 1, it is actually 20. It is 20. It was actually in this case what 20. It was actually 20. So this means these are the posts. These are the posts. These are the posts. Remember the pre, we've already in this case considered them when you're having to do what? Compute what? The goodwill. So what is the portion of these revolutionary reserves that in this case will belong to the group? So you take the posts and you take a portion of it. So still the same case in this case for our what? Our associate. So you're having to be told at this particular point in time, the revolutionary reserves that they have cumulatively, it is actually also what? 50. But in this case, you are only going in this case to take what? The posts. And therefore in this case, we'll take 40%. We'll take 40% of the post. So currently it is 50. But at the point of acquisition, there were how many? 25. So this basically will give us the portion of the revolutionary reserves that in this case are part of what? The consolidated or the group in this case. So you have to do the computation. So 200 plus 80% of the posts for the Shuka, and of course 40% of the post, in this case what? Ajabu. So how much are you having to get? How much are you having to get? 234. 234. 234. 234. So I can see our friend is asking, Malim, what happens to the financial assets in the current assets? So, financial assets. So thank you for the reminder. We are supposed, you can squeeze it somewhere. You can put it somewhere. You need to include the financial assets. Thank you for that reminder. So financial assets. Financial assets. So for the financial assets, we have in this case 30 and 20. You just add them directly the way they are. 30 plus 20. So thank you for the reminder. So this one is supposed to be 50. Therefore, that will mark the end of the current asset. So I can see this one you've gotten 234. 234. Then we have now in this case retained earnings. Retained earnings. For the retained earnings, we had actually done the computation. For the retained earnings, we've done the computation. So how much are we having to get for the retained earnings? I think it's the figure I was asking, which was here. 904. 904.4. Is it 904.4? 904.4. Is that correct? So 904.4. The figure I was asking before we started the class, it was here. Hope it is correct. I hope it is correct. 904.4. Then in this case, we can have the non-controlling interest. The non-controlling interest. So which you also computed. What was the figure for the non-controlling interest? The figure for the non-controlling interest, we've also done it as a working. We've also done it as a working. The figure for non-controlling interest. 138.6. It is 138.6. 138.6. And I think those are the only equity items you'll likely end up having to consider. You'll end up having to consider. So take note, in most of the instances, this ordinary share capital and of course the share premium, they won't change unless maybe you are told after they acquired, maybe they issued more shares, which in this case, maybe they sold them at maybe a premium or something, is when these ones will end up having to change. But you automatically pick those ones of the holding company. You just place them here. So the ones that will have adjustments, they are these ones, the revaluation reserves, and of course the retained earnings, because when you are computing the goodwill here, you only in this case consider what? The pre. But there's nothing in this case you've been able to deal with regarding what? The post. So the post. So the post basically end up having to be part of what? The group. Because now these reserves were in existence after in this case what? The companies were actually what? Acquired. They were actually acquired. And therefore you need to do what? The adjustments for this one and of course these retained earnings. So that's why in this case, majorly we'll do the computation or are working for this and also are working for this, the non-controlling interest. So under the equity items, so standard in this case, you'll have to do a working for the retained earnings and of course in this case for what? For the NCI. So much importance, understand how do I compute the NCI and how do I compute what? The retained earnings, because probably majorly they are the ones that will likely end up having to need what? In this case, adjustments. In any case, for example, they have revaluation reserves, or which sometimes it can miss out in the question. Then in this case, you'll end up having to also do what? The adjustments as you've just been able to do here. So those basically will likely in this case be the part of what? The equity item. So now in this case, we can go to what? The non-current liabilities. We can go to the non-current liabilities. Non-current liabilities. So we have the 10% loan stock. 10% loan stock. So which in this case, it is 500 plus 200. So 500 plus 200. But of course, I told you, there is this one here. You will less it. So the 10% loan stock, you eliminate it. It is an intercompany balance. It is an intercompany balance. It is an intercompany balance. Therefore, in this case, you end up having to less it. So you'll get in this case 600. So this Shuka gave a loan to this other one. So you remove it like that. You remove it like that. So that will be the only adjustment for that. Then we have the current liabilities. So for the current liabilities, you have trade and other payables. So for the trade and other payables, we have 250 plus 250. Because you have to eliminate this one, 50, the intercompany balance, which is here. So it is here under receivables in the other company. It is here under payables in the other company. So therefore you remove it, so that 50. And therefore in this case, you get 450. I think you get 450. You get 450. Then you have in this case what? The current tax. So current tax doesn't have any form of adjustments. So just pick it the way it is. So it is 20 and 20. So the current tax, you can put it here, continue here. So current tax, in this case, it is 20 plus 20. So in this case, you get what? 40. Therefore, you can get the totals. You can get the totals. You get 40. You get 40. So you can give me the figure you're having to get here. You can give me the figure you're having to get there. So this one is trade and other payables. So 250 plus 250 minus 50, 450. Then you complete the entry, the next entry there, it is this one. Current tax, 20 plus 20, you get 40. So you can give me the figure you're having to get for the total assets, the figure you're having to get for the total assets. So what figure are you having to get for the total assets? So I can see you're saying 3667. What about the current, the equity and liabilities? So 3667. What about the liabilities? It is same. I can see you're saying it's the same 3667. 3667. 3667. So take note, some of the figures don't need any form of adjustments. You just pick them the way they are. So like this one, you can see. So it doesn't need any form of adjustments. Like these ones, you can be able to see. No any form of adjustments, no adjustments. These ones, brief adjustments, brief adjustments. This one, there's no any form of adjustment. You just pick it the way it is. So this one, you have to do a working. You have to do a working. So of course, in this case, as I'm having to say, these ones, you can pick them the way they are, the way they are. So you can't actually, in this case, miss out to score a mark. You can't actually end up having to miss out to score a mark. You can't actually end up having to miss out to score a mark, to score a mark, to score a mark. So there was, in this case, the statement of changes in equity, the statement of changes in equity. So to prepare the statement of changes in equity, so you'll ideally, in this case, put these equity items. You remember how we did it under published financial statements. Then remember this one, you've actually been able to adjust. So that working you've done, so there's a working you've actually been able to do for the retained earnings. And of course, now in this case, what? The NCI, or the non-controlling interests. For the retained earnings, and of course, what? For the non-controlling interest. So you ideally, in this case, put it in a table. You put it in a table, and of course, you place all the equity items. You place all the equity items. Then you put the workings like in a table, just all of them in a table. Those equity elements, all of them in a table. So what will happen here? You'll likely, in this case, start with the ordinary share capital, like that. Then share premium, like that. Then revaluation reserve, like that. Then you put retained earnings. Then in this case, you put what? The NCI. You put the NCI. So all the forms of adjustments you've actually been able to make. For example, for these ones, you'll start with the balances brought down. Balances brought down. In this case, we have, this is 1 million. This one is actually 300. This one is actually how much? 300, exactly 300. So these ones, you actually end up having to take those ones for the holding company. Then for these revolutionary reserves, here, of course, you're having to say, in this case, you'll take the 200. But of course, in this case, you end up having to make adjustments on it. So you can actually come here and, of course, indicate the adjustments. So in this case, you can say post-acquisition share. In this case, in what? In Shuka. Post-acquisition share, in this case, in what? In Shuka. And of course, you do this computation. So 80 by 30, I think you get 24 something. 80 by 30, you get 24. You can be able to indicate it here. So 80% multiplied by, in this case, 30. You'll be able to get 24. Still the same case, in this case, you come to the other element, which is, of course, what? Post-acquisition share of revaluation reserves, You indicate in full revaluation reserves. You take 80% of 30, you put the figure there. Then you take, in this case, 40%, multiply, in this case, by 25. I think you get 8. Or something. So this one is 80% of 30. Is it 30? 80% of 30. 80% of 30. Then in this case, 40% of 25, you get 10. You get 10. you go to these other adjustments of these ones, the retained earnings, and of course the NCI. Of course, these ones you've been able to do as a working separately. You've actually been able to do as a working separately. For example, in this case, we did that computation for the retained earnings. For the retained earnings. So for the retained earnings, in this case, for this particular parent company. So for the parent company is actually 710. But of course, there are some adjustments we actually made on it. So we had, for example, in this case, what profit on plant sale. Profit on plant sale, we had to do what less. We had to less. Remember, in this case, these other ones, they don't have figures here, so you can put dashes like that. So you less this one. Then in this case, there was a figure of unrealized profits. I think unrealized profit or something. Unrealized profits. Unrealized profit, it was a figure of 10. So you less like that, you less like that, you less. Then you go in this case to those ones having to affect what? The NCI. So the non-controlling interest. So of course, for the non-controlling interest, we've actually been given a fair value. We've actually in this case been given, in this case, what? A fair value. A fair value. But in this case, you take a portion of what? Of the percentage of what? Of the assets of the non-controlling interest. So you still basically in this case place the workings here. Then of course you place the figure here. Then when you get the totals, you'll just be able to add them. So like these ones remain as 1,000. These ones remain as 300. These ones you can be able to add them. I think you'll get 234. These ones you can be able to add them. You'll be able to get in this case a figure of what we got for the retained earnings. It was 138.6. Was it 138.6? Or 138 points. The other adjustments on these retained earnings, which you haven't been able to. So you also include them here. For example, in this case, we have investee share in post-acquisition profits. So we did that working. You include all those figures here. So that's how basically in this case, you'll likely end up having to come up with what? A statement of changes in equity. So you look at how in this case, the equity items are having to change. Then of course, in this case, you can be able to prepare it. You can be able to prepare it. So that's how you come up with that one. So there's another question which I want us we look at, which I had already been able to indicate we'll be able to look at. December 2022, I want us to look at question number 3. December 2022, question number 3. December 2022, question number 3. So December 2022, question number 3. December 2022, question number 3. Question number 3. So we can have a break of about 5 minutes. So as you look for that particular question, so then I think when it is question number 3A, then I think we can start after 5 minutes. Yes, we can continue. So confirm whether you've gotten that question. Please confirm whether we are there so that we can begin. Confirm whether you are there so that we can begin the question. So have you gotten the question, Beatrice? Beatrice, Augustus, Simuli. Can see Karen Paul says yes. The others you can kindly confirm. Just confirm whether you've been able to get the question so that we can start looking at it. I can see Ruth says yes. Can see Ruth says, Anne Simuli says yes. Augustus says yes. So the question reads, on 1st January 2022, H Limited acquired 80% of the 4 million shares, shillings, 10 ordinary shares of S Limited issued at par value. The acquisition consideration comprised of 3 new ordinary shares issued by H Limited in exchange for every 5 shares acquired in S Limited. In exchange for every 5 shares acquired in S Limited. Additionally, H Limited will pay a further consideration on 31st of December 2022 of shillings 11 per share acquired. H Limited cost of capital is 10% per annum, and the discount factor is 10% for 1 year, is 0.9091. At the date of acquisition, the fair values of ordinary shares in H Limited and S Limited were 15 shillings and 12 shillings respectively. Okay, so the following statements of profits or loss for the year ended 30th of September 2022 relate to the two companies. At the date of acquisition, the fair value of S Limited net assets approximated their carrying values with the exception of an item of plant and equipment which had a fair value of 24 million above its carrying amount. So the remaining economic useful life of the plant and equipment at the date of acquisition was 6 years. At the date of acquisition, it was actually 6 years. Depreciation is charged to cost of sales. Then sales from S Limited to H Limited in the post-acquisition period amounted to 30 million. So that is an intercompany sale, which you have to eliminate. S Limited reported a gross profit margin of 25% on the sales. H Limited inventory includes 1/5 of the goods of these goods as at the end of the year. So that is URP, unrealized profits on closing inventory. Then H Limited policy is to value the non-controlling interest at fair value at the date of acquisition. That automatically tells us that in any case you have to come up with goodwill, we'll get the full goodwill. So for this purpose, S Limited share price at acquisition date can be deemed to be a representative of the fair value of the shares held by the non-controlling interests. Then number 4, H Limited investment income is dividend received from its investment in 40% owned associates, which it has held for several years. The associate reported a profit after tax of 30 million for the year ended 30th of September 2022. So as at 30th of September 2022, no impairment of goodwill was considered necessary. Assume that profits and losses are accrued evenly throughout the year. Then as at 1st of October 2021, the retained earnings of S Limited were 16 million. The retained earnings of S Limited were 16 million. So the required number 1, calculate the goodwill arising on the acquisition of S Limited, then come up with the consolidated statement of profits or loss for H Group for the year ended 30th of September 2022. Note, all workings should be done to the nearest 1,000. All workings should be done to the nearest thousands, So in this particular question here, they want us to only come up with the goodwill, and of course, in this case, what? The income statement. There's no need for statement of financial position, or maybe in this case, what? Statement of changes in equity. So that's what in this case the examiner actually wants us to be able to come up with. So before in this case we we maybe in this case come up with the goodwill. We come up with the goodwill. Maybe we can actually end up having to do some workings. We can actually do some workings, which in this case will likely be of so much help. Which in this case will likely be of so much help. When now in this case we are doing what the computations or coming up with those particular what two statements. So you can start in this case with the workings. We can start 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 with the workings, or in this case we can simply decide to start in this case by having to look at the goodwill, by having to look at the goodwill, by having to look at what the goodwill. So in this case, we said when you are getting the goodwill, so let's say it is goodwill. So goodwill computation. Goodwill computation. So first of all, in this case, to get the goodwill, we said you start with which figure? You start in this case with the purchase consideration. You start with the purchase consideration. You start with the purchase consideration. So what did in this case the holding company actually pay the subsidiary company in terms of what? Having to acquire the percentage of control, the percentage of control. So of course, in this case, for our structure, it is H. It is H. For our structure, it is H. Having to acquire, in this case, what? S. Having to acquire S. So H Limited acquired S. The acquisition is actually 80%. 80%. So when did it occur? It occurred on 1st of January 2022. So it was 1st of January 2022. So of course, in this case, we are called upon to prepare the financial statements for 30th of September 2022. 30th of September 2022. The acquisition happened here on 1st of January 2022. So it means this subsidiary existed in the group for a period of how many months? This subsidiary existed in the group for a period of how many months? For a period of how many months? 9. For a period of how many months? 9. 9 months. 9 months. 9 months. 9 months. So it means the start of the accounting period, it is 1st of October 2021. That is the start of the accounting period. It is October of what? 2021. But they acquired it here on the new year. Then it existed as part of the group for what? For 9 months. So automatically that one actually tells us when you're having to do the consolidation, then we'll have to, in this case, what? Apportion the expenses accordingly to how long this particular subsidiary existed in what? In the group. And of course, what should be able to tell you that we must be able to do this, if you look at, in this case, note number 6, you are told, assume that profits and losses accrued evenly throughout the year. So they accrued equally throughout the year. So therefore, in this case, if it is any expense, then in this case, it means we have to do what? Maybe apportion it for 9 months. For 9 months. That's why I told you in this case, it's very important you take note of the group structure, then of course the date of acquisition, and of course the end of the financial year. So you can be able to tell whether a particular subsidiary existed for the entire year, or maybe in this case, it existed only what? For part of the year. So that one is actually very important. You take note of that. So to get the goodwill, in this case, we said you take the purchase consideration. And of course, in this case, if you're having to, in this case, use the full goodwill method, because we said in any case, the examiner mentions to you that there was a fair value of non-controlling interest. That automatically, in this case, tells you that in this case, you must actually be able to do what? Use the full goodwill method to do what? To come up with what? The goodwill on acquisition. The goodwill on acquisition. So the purchase consideration, of course, you've actually been told as per introduction, that the introduction there. So on 1st of January 2022, H Limited acquired 80% of the 4,010,000 ordinary shares of S Limited issued at par value. So what did they pay? The acquisition consideration comprised of 3 new ordinary shares issued by H Limited in exchange for every 5 shares acquired in S Limited. So of course they acquired 80%. So the acquisition here, the acquisition is 80% of the 4 million shares, So So remember, in this case, we've been able to say that all our figures are actually in thousands. So our figures are actually in thousands. So that 4 million simply means it is 4,000. So it means the shares acquired here in S Limited was how much? 3.2 million shares. 3.2 million shares. It was actually in this case how much? 3.2 million shares. So you're having to be told of these shares, every 5 of them, they were having to give them how many? 3. So for every 5 of them, they were having to give them how many? 3. That in this case, what happened is that they, of course, acquired this one. So this one was giving them 5 shares, then they give them 3 shares. They give them 3 shares. So what they were having to give them as 3 shares is basically what in this case they ended up having to pay as what? As the consideration. As the consideration. And therefore, in this case, we're having to say that if 5 shares, in this case, if 5 shares, they were having to give how many shares? For every 5 shares, they were having to give how many shares? 3 shares. So what about for these? So remember, these ones are the ones that were having to be gotten. That were having to be gotten from what? From S. So S, for every 3 shares, they were having to be given, they were giving 5 shares. It means in this case, for the 3,200, it will likely in this case be what? So 3,200, we multiply in this case by 3, we divide by 5. So what will we be able to get as the number of shares? What will we be able to get as the number of shares? What will we be able to get as the number of shares? That in this case, this H gave to S. What will you be able to get as the number of shares when you do the computation? You get 1920. In this case, you get how much? 1920. You get in this case 1920. So that was the purchase consideration in terms of shares, not in shillings. It is in terms of shares. That ideally what was happening, it is that this S was giving them how many shares? 5. Then of course, they give them how many? 3. How many? 3. So in this case, the number of shares they ended up having to give them was actually in this case how much? 1920. So for every 5 shares, they were getting 3. For every 5 shares, H was actually having to get what? 3. They were getting 3. So in this case, it means for 3,200, they'll likely be able to get this number of what? They'll be able to issue out this number of shares. They'll be able to issue out this number of shares to, in this case, what? To give out to S. To give out to S. But there's something in this case you've actually been told, because in this case, you're having to say the acquisition consideration comprised of 3 new ordinary shares issued by H Limited in exchange of every 5 shares issued in S Limited. So part of the consideration here, number one, it is what? Share exchange. Exactly, share exchange. Of how many shares? In this case, 1920. But at this particular point in time, this H was having to give S shares. The shares of H were going at what price? The shares of H were going at what price at that particular point in time? They were going for 15 shillings. Hope you can be able to see that. So what happened is that H ended up having to give them shares so that they can be able to purchase as a purchase consideration. At that particular point in time, they're having to give them these shares. These shares are actually having to be valued at, it is 15. It is 15. Why are you people saying? At the date of acquisition, the fair values of ordinary shares in H, you can see that paragraph there. At the date of acquisition, the fair values of ordinary shares in H Limited and S Limited was actually 15 and of course what? 12 respectively. So the correct value of these shares they gave them was actually in this case how much? 15. So it means with regard to these shares they gave them, they were valued at what? So they paid them with these shares. They were valued at 15. And therefore in this case, in terms of share exchange, what was the consideration? You can do the multiplication. What are you having to get? You get 28,800. You get in this case 28,800. So that was one of the consideration that this S benefited by having to be acquired 80% of it by H Limited. So they of course gave S what? Shares. But at that particular point in time, the value of these shares, the fair value of these shares was 15. So the shares they gave them in total were 1920 shares. By 15, you get 28,800. That was one of the consideration. Then in this case, if you just continue to read there, so the acquisition consideration comprised of 3 new ordinary shares issued, so that we've dealt with it. Additionally, H Limited will pay further consideration on 31st of December 2022. So they'll pay in this case on 31st of December 2022. So by the end of this year, they likely end up having to pay on 31st of December 2020. They'll pay an extra amount to this S Limited. Apart from shares, there's an amount they'll pay them. There's an amount they'll pay them. How much will they pay them? So in this case, additionally, H Limited will pay further consideration on 31st of December 2022 of shillings 11 per share acquired. Acquired in H Limited. In H Limited. Acquired. H Limited cost of capital is 10% per annum, and the discount factor at 10% for 1 year is actually 0.991. So in this case, there is a deferred consideration. There's what? A deferred. They'll pay in future, like a deferred tax. You pay it in future. There's a deferred consideration. There's a deferred what? Consideration. There's a deferred consideration, whereby they're having to say that additionally, H Limited will pay further consideration of 11 shillings per share acquired. So how many shares have actually ended up having to be acquired? They have acquired 80% of the shares. So they have acquired 3,200 shares. So they'll pay extra 11 shillings per share. They'll pay 3,200 multiplied by, in this case, what? 11 at a future debt. At a future debt, which in this case is what? The end of the year, after 1 year. After 1 year. After 1 year. So of course, there's something you've actually been given there. So of course, they'll pay this what? At the end of the year. But now in this case, we are looking at the fair value at that particular point in time of the acquisition. The fair value at that particular point in time of what? Of the acquisition. So therefore, in this case, H Limited cost of capital is 10% per annum, and the discount factor is actually what? 10% is actually in this case 10% for 1 year. That is how much? 0.901. You'll basically get the value, this particular valuation here. So of course, they'll pay this amount by the end of this year. They'll pay this amount by the end of this particular year. So 1 year would have actually elapsed because they are purchasing it here. 1 year would have actually done what? Elapsed. And of course, in this case, you are told in financial management, when you do discounting, you're getting the value, a future value, you are putting it to a current value. So the future value they'll be able to pay, of course, it will be 3,200 by 11. But in this case, you want to get the value currently when they're having to purchase it. And therefore, you do what? You discount. So therefore, in this case, you'll multiply in this case by 0. You've already been given the discounting factor. 0.991. So what do you get as the value of this money currently? You get 35. You get 35,200. Confirm that figure. Confirm that figure. Is it 35,200? Confirm that figure, Karen Paul. Confirm that figure. You get 32,000. 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 And therefore, in this case, if you're using the full goodwill method, you said you add what? What do you add? What do you add? If you're using the full goodwill method, what do you add? What do you add in this case on the purchase consideration? You add in this case the fair value of what? Of the non-controlling interest. In this case, you add non-controlling interest fair value. Non-controlling interest fair value, you add it on this what? Purchase consideration. You add it on this what? Particular what? Purchase consideration. And of course, you are told under note number 3, look at note number 3. Just look at it very carefully. So H Limited policy is to value the non-controlling interest at fair value at the date of acquisition. So for this purpose, S Limited share price at acquisition date can be deemed to be representative of the fair value of the shares held by the non-controlling interest. You can read it again. Just read it again. So they're having to say H Limited policy is to value NCI at fair value at the date of acquisition. You value the NCI at the prevailing market what conditions in terms of, for example, the value of the share, which in this case you are told it is 12. You remember that statement where we get 15, it is actually 12. So in this case, they're having to say for this purpose, S Limited share price at acquisition date can be deemed to be a representative of the fair value of the shares held by the non-controlling interest. The non-controlling interest. The shares held by what? By the non-controlling interest. The shares held by the non-controlling interest. So according to you, of course, this S Limited has 4 million shares. So according to you, how many shares are held by NCI? How many shares are held by NCI? How many shares are held by NCI? 0.2 by 4 million. Very brilliant. Very brilliant. In this case, the number of shares held by NCI in this case, it is of course 20% because 20% is the NCI. Remember, 80% is for the parent, 20% is NCI. So of course they acquired 80% of the 4 million, but what remained is for the minority shareholders. So it is 20% multiply in this case by the 4 million. Then of course in this case they were having to go, the value was actually in this case 12. So it means the NCI is what? The fair value of NCI is how much? Do the computation. Do the computation. What do you get? 9,600. It is 9,600. It is of course what? 9,600. It is of course what? Net 9,600. 9,600. 9,600. 9,600. Then of course in this case we said you can less. If you've gotten that, you can actually be able to less the net assets, the fair value of the net assets acquired, the fair value of the net assets acquired, the net assets acquired, the fair value of the net assets acquired. And of course, now in this case, the assets, the net assets acquired in this case, you have in this case ordinary share capital. You have in this case ordinary share capital, which in this case is of course it is 4 million shares. But at this particular point in time, it is having to go for 10 shillings. 10 shillings is having to go for 10 shillings. 10 shillings. So therefore, in this case, this one is 40 million. Is it 40 million? Yes, I think it is 40 million. It is actually 40 million. It is actually 40 million. Then, of course, in this case, you have what? The retained. We have in this case what? The retained profits. We have the pre-acquisition. So pre-acquisition profits, said in this case, you consider pre-acquisition profits. The pre-acquisition profits, retained profits, pre-acquisition retained profits. Remember, we said you consider pre-acquisition retained profits. Pre-acquisition retained profits. Pre-acquisition retained profits. And if you look at what you've actually been told, there is somewhere you've actually been told in the last note, number 7, as at 1st of October 2021, the retained earnings of S Limited was 16 million. So the retained earnings of S Limited here on this particular date here, the retained earnings of this one was actually 16 million. And remember, they acquired it after 3 months. They acquired it after 3 months. Sindio. Then in this case, if you look at the profits for the year for the S Limited, it is how much? The profit for this year up to here. The profit for this year up to here is how much? So the retained profits when this year came to an end, 31st of, is it October, this one, it was in this case 16 million. Then we have this one they got for this year. It is coming to how much? You need to get it from the profits for the year, which is in the income statement you've actually been given. It is 42 million. So in short, Ruth, we're having to say that for this year, this particular subsidiary made a profit of how much? 42 million. Is it 42 million? Yes. But in this case, the year before, the retained profits had actually accumulated up to here. So for us to be able to get the pre-acquisition profits for these 3 months, remember, we don't want for the 9 months. We want for the 3 months. So it means we'll be able to take a portion of these profits for the entire year, for the 3 months, we add on this one so that we get, before this debt moving backwards, how much were the profits for this subsidiary. For the 9 months will be post. They will be post. But we wanted the pre. For this year, they made 42 million. When before the year started, the retained profits were 16 million. We need to take a portion of these ones for the entire year, which is 3 months. We add on this one for us to get the pre before they acquired. And therefore, in this case, you can be able to do that particular computation by taking 16 million. So 16 million plus 16 million plus, you can do it 16 million plus, in this case, 42 million multiplied by 3 out of 12. 3 out of 12. What do you get? Multiply by 3 out of 12. Remember, the 42 is the profit for this year. So we need to take a portion of it, then we add on this. Hope it is you're having to get it. Hope you're having to get it. How much are you having to get? 26,500. Are you getting 26,500? Yes. 26,500. 26,500. 26,500. Then also in this case, we said you can be able to consider what? Revaluation. The net revaluation that actually occurred. So you are told in this case, under note number one, at the date of acquisition, the fair values of the S Limited net assets approximated their carrying values with the exception of an item of plant and equipment, which had a fair value of 24 million above its carrying amount. So there was a revaluation. There was what? A revaluation. I need to adjust the camera. So I don't think I need to adjust. It's only that maybe I'm blocking you. It's only that I'm having to block you. So, or how do you want me to adjust? Whoa, this person called Whoa. How do you want me to adjust? So we can add, in this case, revaluation reserves at the date of acquisition. So revaluation reserves, you can add revaluation reserves. So revaluation reserves at the date of acquisition. It was a figure of 24 million. I think it was a figure of 24 million. 24 million. And therefore, in this case, you can be able to add those net assets. You can add those net assets. Yes, you can add those net assets. Whoa, I think that is okay. Whoa. You can add those net assets. What are you getting as the total figure for the net assets? So these ones are basically the revaluation reserves at the date of acquisition. There's an item of plant which they were to revalue by 24 million above. 24 million above. So when you add them, what do you get? You get 90,500. You get, in this case, a figure of 90,500. And therefore, you can less. What did you get here? Give me the figure you got there. Give me the figure you got there. Give me the figure you got here. When you added, in this case, the purchase consideration and, of course, the deferred consideration. You got, in this case, 7,400. You got 7,400. So 7,400 minus this one, the net assets acquired, minus the net assets acquired. $7,400 minus the net assets acquired, you get what? You get negative 2,100. You get negative 2,100. So negative 2,100. So what has actually happened here? It is that in this case, they of course paid this. They of course paid this to acquire the subsidiary. But what they ended up having to benefit overally from the subsidiary was even far beyond than what they actually ended up having to do to pay. Remember, they paid this, but what they got overally in terms of what they acquired as net assets was actually even far beyond what they ended up having to do what? To pay. So therefore, if this is the case, this one is normally considered as what? As a gain. So this one will likely be considered as a gain. So you likely end up having to call it gain on bargain purchase. So gain on bargain purchase. Gain on bargain purchase. So this one will likely be reported as an income in the consolidated statement of income. In the consolidated statement of income. It will be an income in the consolidated statement of income. So in short, what you're having to say, the reasoning behind that, you know, when you talk about a purchase consideration, it is what this holding company actually paid the subsidiary. So ideally, they were supposed to pay them, or they paid them 70,400,000. But what they benefited, because in this case, they were acquiring the net assets of the what? At that particular point in time of acquisition, they were acquiring what? The net assets of what? Of, in this case, what? The subsidiary. And the net assets in total, they were coming to 9,500. It's like in this case, in short, in a layman's language, in this case, the subsidiary gave them assets what? 9,500. Then they paid them 7,400. It's like waliangukia deal. So they didn't exactly pay an extra amount. So therefore, in this case, it means if this is the case, it's like they benefited. And of course, in this case, if it's a negative here, it will be a gain on the bargain purchase, which in this case, we'll be able to recognize as part of the incomes in the consolidated income statements. In the consolidated income statements. In the consolidated income statements. Income statement. So that's what basically in this case, you likely end up having to do that what? Computation. So, but whenever in this case, it would have actually been a positive, then we would have been able to consider it as what? As an extra asset, which they got as a result of acquiring what? The subsidiary. As an extra asset they got as a result of what? Acquiring the subsidiary. So that is what will likely end up having to happen regarding what? That what? Computation. Regarding that what? Computation. Regarding that computation. Regarding that computation. Regarding that computation. So I don't know whether we can be able to continue, because I don't want it to, I didn't want in this case to go to, because we might not end up having to finish it. I don't know whether we'll be able to finish that, those workings, but maybe what I'll do, let me just end there. Let me just end there. What you can do in this case, there was a friend of ours who was asking how I got this one, the deferred consideration. So this one, we're having to say they paid it in what? In future. Remember, in this case, they acquired this particular what? Subsidiary on this particular debt here. But for this amount, they never actually ended up having to pay it what? Immediately. They paid it after what? After like a year. So they paid it after what? After a year. They paid it after a year. So they acquired it here at the new year, mwaka mpya, then wakalipa at the end of the year. They paid this amount at the end of the year. And of course, we've actually been able to say this deferred consideration, you've actually been told that in this case, it was as per the first paragraph. Additionally, H Limited paid further consideration on 31st of December of 11 shillings per share for the shares acquired. The shares acquired in this case, it is 3,200, which we've actually computed here. They acquired 80% of the 4 million shares of the subsidiary. So in total, they acquired 3,200 shares from what? From the subsidiary. So the deferred consideration, what they paid in future, they're having to say they were supposed to pay 11 shillings per share of these shares they acquired. And therefore, in this case, they paid how much? Of course, they paid 3,200 multiplied by 11, because that is what they're supposed to pay. But now in this case, ideally, we're having to say, we need to look at this value of money that will be paid in future. What is the current value? What is the fair value of these amounts that will likely end up having to be paid? What is the fair value of the purchase consideration? And therefore, in this case, you do what you call what? Discounting. And therefore, in this case, in your financial management, you must have actually been told, when you talk about discounting, is bringing a future value to the current value. What will it be like? What will it be in this case like? So we have discounting. And what is the opposite of discounting? Compounding. Compounding. We have in this case what? Compounding. We have compounding. So I can see Augustus is insisting we finish. Is insisting we finish. So do we finish? Let's hear what the class will end up having to say. But I know we won't finish. We won't be able to finish, because the problem is that they are going to use this particular they're going to use this particular link for another class. So where did I get revaluation? So, and see in this case, so many questions are still having to come. Where did I get in this case what? The revaluation. It is a note number 1. Means you can look at note number 1. At the date of acquisition, the fair value of S Limited net assets were approximated, and their carrying values, with the exception of an item of plant and equipment, which had a fair value of 24 million above its carrying what amount. So they looked at, in this case, all the assets of what? This subsidiary. So all of them were okay. But there was one item of plant which was supposed to be revalued up by 24 million. So in this case, when you're having to, in this case, consolidate, we're having to say you consider the value of the assets at what? At fair value. So it's only fair that in this case, we actually consider it as part of the assets if we've been able to, in this case, bring it what? To the fair value. So we report in this case what? The assets at what? At fair value. So one of the items, they're not actually done what? A revaluation. And therefore, in this case, that's where you're having to have what? A revaluation reserve here in the subsidiary, which basically in this case is like what? Part of the net assets on what? On acquisition. And remember, in this case, as per the formula, we said that if you are looking at what? The goodwill, you take the ordinary share capital if it is there, then the pre-acquisition retained profits, and the revaluation reserves, or the pre-acquisition what? Revaluation reserves, or revaluation reserves at the date of acquisition, which in this case is exactly what? 24 million as per note number 1. Then in this case, you get what? This, you minus this, you get a negative, which I've told in this case, we'll refer to it as what? As a gain on bargain purchase. A gain on bargain purchase, which will appear as an income in the consolidated income statement. In the consolidated income statement. In the consolidated income statement. So we can end there. So let's end there. You can try to practice. But what I can advise you, so repetitively go through, in this case, the questions for what? For consolidation. That is how you'll end up having to grasp these particular questions very easily. It doesn't have the normal double entry you know of that is normally very direct. The double entry is basically, in this case, a bit confusing, and you might actually find it's not like in this case the other normal double entry we do, like for any other what? Topics. So this one, you'll end up having to say you debit this one. You'll ask yourself so many questions. Why are we debiting this one? It is not that direct, but that is basically, in this case, how we do the reporting for consolidation. So the best thing is for you to do repetitive revision, going through the videos. You even go back through a video even 3 times. You go back again, you do 3 times. Then also you try to do what? Practice. For example, in this case, as the particular point in time you've actually been able to reach, you can try in this case to come up with what? Your income statement. So you make a mistake, then in this case, when I come to do it now, you realize I had made a mistake, but now in this case, the right way to do it is like this. It is like this. So that is very important. So let me not, in this case, complete it, because I know we'll be caught with time, and of course, there'll be another class having to use this particular what? Link. So you can try to practice as an assignment during the weekend by coming up with what? With the income statement. And I think it will likely be, okay. It will be okay. So the next thing we'll be looking at after these ones, we are supposed to look at group cash flow statements. Group cash flow statements, so which I don't know. So maybe let's see what happens on Tuesday. So if I might come in to finish on Tuesday this one, or what will happen, my colleague will likely come in to do what? Group cash flow statements. So my colleague, Dr. Joshua Ora, might come in to do what? Group cash flow statements. But maybe I'll come to finish on Tuesday, then he'll come in on Thursday. He might come in on Thursday to do group cash flow statements. So I think that will likely be okay. So we are not far away from having to finish the syllabus. Take note, the areas we've actually been able to cover regarding theory parts, and we did them during lunch hour. So go to the LMS and go through those videos, because I'll finish up that part. But it is important. There are like 3 videos we've already done for the theory part. Remember, the theory questions will likely almost be like 30%. In most of the instances, 30%. So you can imagine if you can be able to maximize in theory and get even 20%, then you go to these other areas, you try to get even what? Maybe 40. You would almost in this case be at 60. You would almost in this case be what? Be at 60. Be at 60. And of course, you'd be able to pass. So some of the students ignore theory. Don't ignore. Don't ignore. It can be the savior. It can be the savior. It can be the savior. Don't ignore. So I'll go through all the parts for the theory part. Then I think it will likely be okay. Otherwise, let me end there. So we can end there. You can start enjoying the weekend. So don't stress yourself a lot. Just enjoy the weekend. Go through these things slowly by slowly, and I think all will be well. Thank you very much and have a good night.